Good day, folks. I really want to share with you today a new investment thesis and a new investment vehicle I'm seriously considering adding to my portfolio very soon, thanks to the onslaught of AI data centers. The electrification of everything, including like electric vehicles, are literally sending utility bills soaring across the states. Heck, thanks to these data centers, adjacent states are even seeing their utility bills go up. And I want to dive into this just a little bit because I'm always looking for investment vehicles that typically have lower volatility and are starting to, extend returns beyond their historical averages. And, those two check marks make me pretty excited to continue to deep dive into whatever those investments are. And we got to talk about the utility sector as a whole, right? I mean, right now, my primary exposure between my fiance and I is in tech. Like, we've been major tech investors for most of our lives, with the exception of VDY, but even the S&P 500 today is majority tech. And if you take a look at VDY, firstly, utilities only make up about 6%. If you consider Enbridge a utility, it is definitely one of the largest holdings within VDY, making up about 7.4%. There's debate on whether it's a utility or energy company, but it is servicing some of the major conglomerate companies like Meta and Amazon with their warehouses and data centers through renewables. Like, they have some pretty large contracts that they're helping serve some of the energy needs. But in the S&P 500, utilities are barely 2.3%. Like, it is non-existent. So when you're cost averaging into these ETFs, there isn't a lot of money that is driving into the sector that's causing like crazy overvaluations or anything like that, because market cap weighted ETFs will only weight the largest companies that are growing the quickest and, giving you exposure to the best returns in the market. And utilities can offer the best returns, but it'll take a lot of time for utility to become big as a company like Apple or Google or whatever, right? So I've been seriously considering, and as a Boglehead, if you know Jack Bogle, the inventor of market cap weightings, Vanguard itself, I've been really looking at VPU, which is up 18.5% before the dividend. With the dividend, it's up over 20% and has offered returns now above its historical averages of around 9%. And in the last 3 years, it's been doing about 13%, right? But if you look at the 5 year, it's been around 10%. A lot of these extended returns have only been happening as of recently. And I think it's a market, again, that is just largely not being paid attention to as much. We're only seeing the headlines from companies like Oklo, like some of the more up and coming like modular nuclear reactors that aren't really implementing, anything as aggressively as these mega caps are. And I want to talk about it because like it's market cap weighted. So you're getting largest exposure to things like NextEra Energy, Constellation Energy, Southern Company, Duke Energy. And in the past, I've actually owned Southern Company on an individual basis, and it offered incredible returns, but I later sold it to index my portfolio. Regardless, let's talk about firstly the top three holdings, because again, they are starting to offer extended growth, again, beyond the historical norms. I mean, this NextEra didn't really do much for almost 5 years. I mean, the stock was basically just flatlining. But NextEra Energy, they're announcing partnerships, guys, with the mega cap companies like Google to accelerate nuclear energy deployment in the US. Like, mega cap companies are getting behind the mega cap utilities right now. And it's quite impressive because NextEra basically is an owner and operator of the largest electricity utility in the US, operates America's largest gas-fired generation fleet, a world leader in renewables, world leader in energy storage, operates one of the largest nuclear fleets, America's leading transmission utility, and leading competitive transmission developer. We are literally in an extending industrial revolution. Like I said, guys, like outside of technology, which you can argue is a bubble or not, regardless, the energy demand is just ballooning right now. And we're seeing that also bleed into commodities, right? The reason commodities are so expensive is because all of that plays into the technology, and a lot of it plays into the expansion of the power grid too. So, I mean, you can tell that this crazy bull market we're in, this new growth period, is extending to all these different areas. But utilities just come with a different level of stability because, again, energy demand is very consistent, guys, and you're not going to shut your lights off even in a recession, proving that it's kind of more of a recession-proof business, though you could contemplate whether you're going to buy another iPhone or not, right? So if we take a look at NextEra, like they've been beating every earnings guidance expectations for the last 4 quarters. Great growth from this company. You look at the financials, and again, if we take a look at the quarterly, they are starting to go back to new all-time highs. If you go back to the quarter ending of 2024, the third quarter, 7.5 billion, and now they're at 7.9 after things slowed down a little bit in the revenue side. Regardless, if we take a look at something like Constellation Energy here, this one's gone on an absolute rally. Like it's blown up. I mean, the stock kind of came public in 2022, and it's already up almost 700%, and it's up so much just because of the nuclear side. Like this company is involved with Microsoft that is starting up that nuclear power plant on that island. I mean, they've signed 20-year like partnerships with Meta. This company they're just becoming huge conglomerates. Like they're literally becoming the go-to for the major tech companies out there. So I mean, when I've been digging through this, I've just been blown away because complementary capabilities will create value for combined companies. So largest nuclear fleet, leading natural gas fleet, largest geothermal fleet, battery storage, renewables, right? Like, and the only companies we really hear the headlines from again are Tesla on some of these things, on Okla. Like they're always like the high flying overvalued stocks, but never the actual implementers that are doing it at scale at profitability today, right? So if we take a look at Constellation, again, it historically, right now, when we go through the quarterly revenue here, it actually hasn't been that crazy. It's been flat mostly for the last 5 years, but we're moving into a new place of guidance, right? I mean, we're expecting to see some excelled returns moving forward that are above the historical averages. Southern Company, now these ones are a little bit more boring, but offer way more stability. Typical decent returns, but look at the growth here. You don't get a lot of hiccups when it comes to keeping the power on, right? And there's nothing crazy about Southern Company. I kind of scrolled through some of their earnings. And again, they got contracts for 8 gigawatts, an increase of 2 gigawatts versus the prior quarter. They're seeing large load customer updates going on. So they have over 50 gigawatt large load pipeline through the mid 2030s right now. And if you dig into Southern Company, guys, again, if we take a look at the financials here, actually just take a look at the analysis, because the only thing I really care about is the fact in the last 3 quarters they've been beating analyst expectations. Again, we're not talking about companies like tech right now that are showing like massive signs of growth. We're just starting to see pipeline implementation. And that's kind of what's getting me so excited here when I've been digging through like Duke Energy and Southern Company and just kind of diving into what's been going on here, because I think this is Duke's financial report off their presentation, and they're giving adjusted EPS guidance, right now, reaffirming growth of 5 to 7% through to the beginning, reaffirming growth rates through 2029 with confidence to earn in the top half of the range. So again, I think they're going to go maybe above the top half, but again, this is the historical norm for the mega caps, is like maybe 5 to 8%, but we're again excelling beyond that, and it's only something that just started recently. It's not something that a lot of people are talking about, even though we hear about it in the news and the headlines. And when you're buying into your technology companies and your chip companies and, all these other companies and your gold and precious metal and, commodity companies, I feel like utilities are just kind of getting shoved under the radar because they're not part of the upper weighted aspect of these ETFs that most people cost average into. So I feel like, again, I might, just to extend some dividends in my portfolio, continue to offer stability, I might trim a little bit of my S&P 500, just a little teeny bit in my RSP to start adding into this utility ETF, which in next year I will buy a lot more of it in my RSP and maybe start adding it with my US funds in my corporate account. That's kind of where my thinking is at right now, but I'll pass the question off to you. I'd love to know what you think about this thesis in that comment section below.